Hello, everyone, and welcome to the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'm going to be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what we've got on tap for today's show. First, I'm going to be talking about a question that comes up often, it seems for me, and that's the question of whether or not you need a financial planner. So I'm going to give you some thoughts on how you might figure that out for yourself. Second of all, we're going to be talking to our mortgage pro, none other than Steve Tetzner with Homestar Mortgage. He's going to be with us to talk about a couple of important documents you should be familiar with if you ever get a mortgage. So we're going to go through that with Steve coming up. And then the question of which president has actually delivered the best returns in the stock market during their tenure. The market's been on quite a tear since President Trump has been elected, so we'll see what he's got to contend with over his term to see if he can break into the top lists. So, and then finally, we're actually going to address a viewer question we got from Facebook, so that's coming up at the end of the show. So let's jump right into it. A question I get a lot is the question of whether I really need a financial planner. And I'll confess, it doesn't usually come as, hey, Oliver, do you think I need a financial planner? It's more like, hey, Oliver, I don't need a financial planner. I don't know why anybody needs somebody that does what you do. So obviously, I wouldn't be in the business I'm in if I didn't think at least some people needed a financial planner. But it's something that comes up often enough that I want to give some people an idea because not everybody needs one. I will be the first one to admit that. I want to give people my thoughts on how they might decide if needing a financial advisor is something that is in their situation. And it's what I call the 3 Ds. So let me throw them up, and I'm going to talk about them each one by one. And the first one is desire. The first thing that I ask people that are considering whether or not they need a financial planner is, do you actually care enough about your personal finances, and not just your personal finance, but the topic of personal finance, to do what's necessary to manage it to the level of expectation you have? We all have a certain level of expectation about where our finances should be, where we want them in the future, and one of the questions is, are you interested enough? It seems like personal finance is one of those topics like football and music that society thinks everybody should be interested in. And the reality is some people just don't care about personal finance. They're just not interested in IRAs and stocks and bonds. And you know what? That's okay. So the first question you have to ask yourself is, do you really have the desire to pay a lot of attention to it, at least to the level that you feel is necessary to manage your personal finances? The next D, dedication. It's going to take some commitment. It's going to take commitment in a couple of categories. First, do you want to make the commitment to take the time to learn what you're going to need to know? Now, personal finance is not rocket science, okay? It's not about trying to put a man on the moon or build a nuclear reactor or anything like that. The concepts and the techniques are things that any reasonably knowledgeable person can do, but you have to acquire the knowledge. So are you willing to commit the time to talk to people, to watch shows like this, to read publications, to go online, to get the information, and to know enough to filter through the right and the wrong information so you can make determinations that are appropriate for your situation? The other part of the time is, are you willing to dedicate the time to pay attention to your finances? It doesn't take a lot of time, but things need to be organized, they need to be updated, and they need to be reviewed on some kind of regular basis in order for you to achieve the goals that you, in all likelihood, have. So are you dedicated to committing that time? The final D, and I think this is absolutely the most important one, do you have the discipline? Can you maintain the discipline to stick to a long-term financial plan and not let your emotions manage your decisions? The reality is that money is one of the most emotional topics we deal with. We're not particularly emotional about other people's money, but we get very emotional about our own money. So the question is, can you maintain discipline in the face of a falling market, in the face of a rising market, in the face of something you'd rather do now despite your plans to do something else later? Can you maintain discipline to achieve your plan? So if you can do those 3 things, if you can have the desire, have the dedication, and most importantly, have the discipline, you can probably do it yourself. If you don't have one of those 3 ingredients, maybe you want to consider talking to a financial planner. So those are my thoughts on that topic. All right, up next, we're going to be talking to Steve Tetzner, our mortgage pro, about a couple of important documents you should be familiar with when it comes to a mortgage. Stay with us, there's more to come. Welcome back to the Money Pros. I'm joined by Steve Tetzner, our Mortgage Money Pro. Steve, thanks for being with us once again.
Thank you.
Interesting topic, I think, and I think that in any industry, we all have sort of preconceived notions for those of us that are not involved in the industry. One of my preconceived notions about the mortgage industry is it's just a paperwork blizzard.
We kill a lot of trees.
So this is one of the questions, this is the first question I wanted to ask you, and we're going to talk about two pieces of paperwork in particular, so we're not going to cover the gamut. But before we get into those, if I am in the process of applying for a loan, and I go from start to finish, from applying all the way through to closing on the mortgage, how many forms am I going to sign or initial from end to end in that process?
Well, it depends on the type of loan. A government-insured loan, like an FHA or VA loan, it's going to increase dramatically. But there are an estimated 45 to 50 disclosures, or pages of disclosures that you sign just as part of the application. Then you will re-sign all of those at closing in addition to other closing documents. So, you know, you're well over 100 in the course of the transaction.
So if a borrower feels like they're getting carpal tunnel when they're acquiring a house, it's not in their imagination. It's quite possible that that's happening. So one of the things you mentioned that I wanted to ask you a little bit more about is that the paperwork can vary depending on the type of the loan. Can you give us a little more insight into what different types of loans and how the paperwork might change?
Sure. I mean, you have your basic conventional loan. That's your Fannie Mae, Freddie Mac, typical loan. So those have both federal and state disclosures, and also disclosures that are required by Fannie Mae. But understanding a lending institution is regulated by the CFPB, so we have to comply with federal regulations, and then individual states have division of banks, DBR, which we also have to comply with their regulations. So depending on the state, the disclosures can vary based on what those state-required disclosures are. The conventional loan probably has on average about 45 pages to 50 pages of disclosures. When you add in a government-insured loan, you will sign all of those disclosures, and then in addition, government-required disclosures for that specific type of loan that are required either under FHA, VA, USDA, depending on what the entity is that's actually insuring the loan.
So you used a word that you've used a couple of times now, and that's disclosures. It seems like a lot of the paperwork is essentially driven by regulation, who the regulator is, what things they require, and things like that. You've been in this business for a long time. How have you seen the paperwork expand from the beginning of your career to where we're at right now? Is it getting better or worse?
I would say that the paperwork has increased by about 40%. I've been in the business for 21 years.
And that's a stunning increase. And it's not just about trees. We're not, you joked, but it's an amazing increase in what consumers have to digest.
Well, what people don't realize is the government, whether it's the state or the federal government, something will happen and they'll create a new disclosure. Well, every time they create a new disclosure, they never eliminate one. So the disclosures just keep growing and growing, and we're up to a ridiculous amount.
All right, so we've got a lot of paperwork, but we're not going to talk about all of it today. We'd need, I don't know, a season's worth of the Money Pros probably to talk about all the documents. We want to focus on two of them, and the first one we want to focus on is perhaps the most important, I don't know, you tell us, but is the actual application itself. So my first question is a application for a mortgage standard throughout the industry, or does it vary? And if it does vary, how does it vary?
The term is called the Universal Residential Loan Application, URLA, and it is exactly the same no matter where you get a mortgage.
Okay, so it's not the bank, it's not the state, it's a
standard
common
industry.
application.
Yep, it's required federal, and it's used for no matter what type of mortgage you are applying for. That is the form that has to be completed by every consumer.
So any residential mortgage then,
Correct.
It doesn't matter who the lender is or anything like that. Now, one of the things that you and I talked about leading up to the show, you made mention of the fact that the application is going to see some significant changes upcoming. Can you tell us anything about that?
It's basically, it's going to incorporate a lot more data. So there's going to be more questions and more fields that the borrowers are going to have to complete. And it's all about data collection and making sure that there's no fraud involved in the transaction. So it's probably, I would say, an average of about 20% more questions and more data fields that are going to have to be completed. And it's really about Fannie and the federal government collecting more data on people.
Now, when somebody's applying for a mortgage, I'm envisioning, and I've applied for a few mortgages myself, but that you're not just sending them out a blank application. There's a process for helping a borrower fill out the application, or do you have like a fact-finding sheet that you use to then complete the application? Or do they actually just get an application that they fill in?
Typically, I don't know of anybody that does that. I mean, someone might collect data through an online portal, or collect data over the telephone, or have somebody email you some information. But usually when an application, a formal application is done, a loan officer, a licensed loan officer is involved in completing that application, because some of the data that is incorporated and required, the consumer wouldn't be able to answer the questions. The interest rate, the term, the type of loan, is it a fixed, is it an ARM, is the interest rate locked, is it floating? So you do need a loan officer involved in the process.
So that's the application, and that sounds like the thing that's going to get the whole real process started. But then the next and also very important document that we want to talk about is the loan estimate. And this we want to spend some time talking about. So let's start off with, what is the loan estimate? When does it come into play in the process?
Well, different companies do it differently.
Okay.
We do everything what we call point of sale. So at the time that the customer applies for the loan, we do the actual application and all of the required disclosures, including the loan estimate, the servicing disclosure. Everything is done at time of application, when we're either sitting with the borrower or when we send it to them for their signatures. What other companies do is all those other accompanying disclosures are required to be sent to the borrower within 72 hours of application, within 3 days. So they might collect the basic data, and then they have another department that will actually send out all of the other disclosures, including the loan estimate and the other documentation.
So what is the loan estimate? What's the information that's in there? What purpose does it serve exactly?
Actually, in my opinion, the loan estimate is the most important document.
Okay, so not the application, but the loan estimate.
Yep. The
Okay.
loan estimate really encompasses all of the financial information and all the pertinent information of the loan. So it tells you what type of loan that you're applying for, tells you, the address, the loan amount, the interest rate. It tells you whether that interest rate is locked or whether it's not locked. It tells you whether it's a fixed or an ARM. If it's an ARM, it gives you disclosure on what can happen with the payment over the course of the ARM. Shows you a breakdown of your monthly payment, including your principal and interest, breakdown of your escrow for your taxes and insurance. If there's PMI, that's also all broken out. That's just on page 1.
Okay.
Page 2 then has a breakdown of all the costs associated with obtaining the loan. You have your closing costs and your prepaids. The closing costs, by definition, are all the one-time fees associated with obtaining the loan. Lawyer fees, appraisal fees, underwriting fees, credit report, title insurance, recording fees. So those are all the one-time fees. Then you have your prepaid items, which are interest, taxes, and insurance. So when you buy a home, you have to prepay your first year's insurance on the house. You have to establish usually an escrow account for your taxes and insurance. And then there might be some interest adjustments depending on what day of the month you close. The prepaid expenses are exactly the same, assuming you're escrowing, no matter where you get a mortgage. They don't change. They're just adjustments based on when your taxes are due, when you're closing, when your first payment is. It's just a formula.
How much oil's in the oil tank?
That's a little different. Yep, those are adjustments between the buyer and the seller. That would come into play on the closing disclosure.
Okay.
Which is
We'll talk
a whole
about
other
it.
show.
Yeah, we're gonna save that for another show for those of you that are interested in closing disclosure. But the loan estimate, has that always existed, or has it changed other documents that borrowers might have been familiar with from an older period of time?
Yep, that's a great question. So what that did is it combined the good faith estimate and the truth in lending disclosure. So everyone always used to say, well, get a good faith estimate when you're getting a mortgage so you know what you're being charged for fees. The good faith estimate doesn't exist anymore. So it's now been rolled, that data is now rolled into the loan estimate. The loan estimate also on the third page has all of the APR, annual percentage rate calculations and all that information, which used to be on your truth in lending disclosure. It also has servicing information. Does that lender service their mortgages? Does the loan have a prepayment penalty? So a lot of the data that was on the truth in lending disclosure.
So it sounds like, what I take out of this is no matter what anybody's told you in writing, over the phone, in an email, what you're getting is that loan estimate. That is the official, here's what your loan is going to look like, barring changes that may happen from this point moving forward. And we can talk about that. The next question I want to ask is exactly that, which is the loan estimate, I presume, is exactly what the name implies. It's an estimate. How much can it change between when you receive it at application and when you go to close?
In the closing cost portion of it, very, very little. The fees are guaranteed. So once a consumer receives the loan estimate, there are different sections of the loan estimate where certain fees are broken out and they fall into different categories. Depending on the category, some of the categories can have zero change that are not in the consumer's benefit. So if you disclose certain fees, those fees cannot go up by 1 penny. They could get reduced, but they can never increase.
Okay.
Other areas have a tolerance where you take all of the fees that are in that certain category, and there's a 10% tolerance. So all the fees that are disclosed in that area, the change to the consumer cannot be greater than 10%.
So we've only got about half a minute left, but would you advise borrowers at some point to compare the loan estimate to the final loan information to make sure that there's no changes there? Is that an appropriate thing for a consumer to do?
They certainly could, but all the federal lending regulations, it's done for them. The loan would be in direct violation of federal law if all of the criteria is not met.
All right, there's a lot going on there. And we didn't touch the closing disclosure, which we want to save for a future show. So that is going to be next time we have you back.
Great.
All right, Steve, thanks very much. Great information. All right, up next, what presidents generated the best stock market return over their tenure? We're going to tell you the information coming up on the Money Pro. Stay with us. Welcome back to the Money Pros. We've talked a little bit on the show, previous shows, about how well the stock market's been doing since Donald Trump was elected president. It's an interesting topic, particularly because, you know, during Election Day, the market, or Election Eve, the pre-market information didn't look very good, but then when the markets actually opened, stocks bounced substantially. So we've talked about that, and that brought up the topic, and I read an interesting article on it recently about what presidents during their tenure have actually seen the stock market go up the most. So I wanted to share that information with our viewers. So Donald Trump, at the time of this taping, isn't 100 days into his presidency, so he's got a ways to go before we can make a final determination on whether he was good for the stock market or not. But let's talk about some past presidents and their numbers. So we throw up the slide, and on our countdown, number 3 is our most recent past president, Barack Obama. So Obama was president from 2009 to 2017, and he really experienced a pretty solid run up in the market. His average monthly rate of return, and that's a monthly rate of return, 1.03%. So that's certainly a healthy number, puts him number 3 on the list. The thing we have to keep in mind is he came into office really in the depths of the financial crisis in 2009 after we'd seen the stock market decline so dramatically. So he really had the advantage of not only a rebound, but then an expansion on top of that. Next up, number 2 on our list, another Democratic president, none other than William Jefferson Clinton. Clinton was in office from 1993 to 2001, and his average monthly rate of return during the time he was in office was 1.22%. Of course, for those of you that are stock market students, you'll remember that a big chunk of Clinton's presidency was marked by the dot-com boom that really extended from the late 90s into 2000, and of course we saw a significant bust shortly before he left office that was further exacerbated by the tragedy of 9/11, which saw the markets decline substantially during the early part of Bush's tenure. So Bill Clinton was also the beneficiary of some good timing there as well. But number 1 on the list, Calvin Coolidge, in office from 1923 to 1929, average monthly rate of return 1.74%. Of course, helping Coolidge's average rate of return was the fact that he got out of office right before the Great Depression. The reality is presidents have very little to do with stock market performance, but it's always interesting to take a look at the numbers. All right, up next, we're going to answer a viewer question on a notice they got from the state of Rhode Island with respect to their taxes. Stay with us, there's more to come. Welcome back to the Money Pros viewer question time, and this one came to us via Facebook, and it's a great question, so let me get right to it. Viewer writes, I have a question about my taxes. I was recently sent a notice of deficiency by the state, and this is the state of Rhode Island, concerning 2012 tax year. This was 5 years ago, and I have never been notified by the IRS or Rhode Island before this notice. I am being charged penalties and interest that doubles the amount that I actually owed. Can the state go back this far? And can I be charged these penalties even though I have never received any notice previous to this? Great question, and for the exact answer, I went to our tax pro, Greg Piccaro, CPA with Otrando and Piccaro Associates, and his answer was essentially this. There's no statute of limitations for tax collection in the state of Rhode Island, so they can go back as long as they want. The reality is that the state can charge penalties and interest regardless of whether you received a notification or not. So the fact that you never got one before bears no impact on the situation. His advice is to call the state to see what caused the notice, find out what the problem is, and the reality is it may be incorrect because the state, and the IRS for that matter, is not infallible. Even if the notice is correct, depending on the facts and circumstances, you may be able to request an abatement of the penalties and interest and only have to pay the actual tax liability that's due. But you should do that as soon as possible because the reality is that the state charges 18% interest and can put a block, get this, a block on your driver's license and your vehicle registration ability if you don't get this cleared up. So, no statute of limitations, and it behooves you to contact the state as early as possible to get this rectified. If you have a question for me, please reach out. You can find us on our Facebook page, The Money Pros. You can email me, moneypros@foxprovidence.com, and you can visit our website, go to foxprovidence.com, click on The Money Pros and click on Ask a Pro. I answer all of our questions, even if I've got to get one of our other pros involved, and we may even use your question on the air. So please do not hesitate to reach out to us, and thank you to the viewer who sent that question in about tax returns, because it's interesting to find out that there's no statute of limitations in Rhode Island. All right, that's it for today's show. As always, thanks for watching The Money Pros. We hope to see you again right here next Sunday. Take care, folks. Have a great weekend.